Welcome back to Smart Stock Sam, the channel where we dig past the headlines and find the real story the market hasn't fully priced in yet. And today we are going deep on HIMS and HERS Health, ticker HIMS. Is the $30 breakout real, or is it a bull trap waiting to snap shut? By the end of this video, you will have my honest, unfiltered verdict, including the two numbers from the upcoming earnings call that will tell us everything. Let's get into it. First, let's talk about what the price action is actually telling us, because the chart on HIMS right now is one of the most violent and fascinating recoveries I have seen in the healthcare space in a long time. Since the February bottom, this stock has exploded by 125%, 125. In a matter of weeks, it reclaimed the psychologically critical $30 level, and just in the last week alone, it posted a recovery of up to 8.56%. Now here is where it gets interesting. Despite that massive surge, HIMS is still technically down between 8 and 17% year-to-date. Let me say that again. A stock that has rallied 125% from its lows is still underwater for the year. What does that tell you? It tells you there is still significant room for recovery if the underlying story holds up. And that story, the one that actually explains why institutions are piling in, starts with one of the most controversial drugs on the planet. For months, HIMS was fighting a war it probably could not win. They were selling compounded versions of GLP-1 weight loss medications, essentially lower-cost alternatives to branded drugs like Wegovy and Ozempic. Big Pharma was not happy. The legal and regulatory cloud hanging over the stock was suffocating investor confidence. But here is what changed everything. HIMS didn't just survive the regulatory fight, they flipped the board entirely. By settling patent litigation directly with Novo Nordisk and integrating into Lilly Direct, the company transformed overnight from a legal target into an authorized distributor of branded Wegovy, Ozempic, and Zepbound. Think about what that means. The same drugs they were being sued for compounding, they are now authorized to sell. They have essentially been invited inside the tent. That is not just a legal settlement. That is a complete strategic reinvention. They went from fighting the system to being part of it. And the market is only just beginning to understand the full implications of that pivot. But here is the part most people are completely sleeping on. And this is where it gets really exciting. Mark your calendars right now, July 23rd and 24th. Those are the dates the FDA is scheduled to review compounding restrictions on key peptides, including BPC 157. Now you might be wondering, why does a government committee meeting about peptide compounds matter for a telehealth company? The answer is extraordinary. Back in February 2025, months before this FDA review was ever really on the market's radar, HIMS quietly acquired a dedicated peptide manufacturing facility in California. They didn't wait for the news. They prepared for it. If the FDA eases these restrictions, and there are serious arguments that they will, HIMS is positioned to pivot almost overnight from being a branded drug distributor to becoming a vertical manufacturer of their own peptide-based products. That is a completely different margin profile. That is a completely different valuation story. And that is why I keep saying the market has not fully priced this in yet. Could the FDA rule against easing restrictions and leave HIMS holding an expensive facility with no clear use case? Is there any chance that billion-dollar institutions, with their armies of analysts, completely miss a regulatory catalyst this significant? The probability is low, and that asymmetry is exactly what makes this setup so compelling. Now, no growth story exists in a vacuum, and HIMS is dealing with real competition that you need to understand. When Amazon One Medical launched its competing GLP-1 program, HIMS shares dropped 4% in a single session. That is the Amazon effect. Just the announcement of their participation spooks investors. At the same time, their direct rival Ro has been aggressively slashing membership prices, trying to start a price war in the obesity treatment space. These are legitimate competitive pressures. But here is the differentiator that the data keeps pointing back to. HIMS is the only player in this group that is currently showing genuine bullish momentum despite all of that noise. While Amazon is leveraging brand recognition and Roe is competing on price, HIMS is doing something more sophisticated. They are building a dual-track strategy that combines authorized branded distribution with the optionality of proprietary manufacturing. That is a moat that a price war alone cannot destroy. Let's talk numbers, because the financial picture here is genuinely impressive. In the fourth quarter, HIMS posted revenue of $617.8 million, up 28% year over year. They now have 2.5 million active subscribers, and that is not just a vanity metric. That is 2.5 million people paying recurring fees for health services, which means predictable, compounding revenue. For the full fiscal year 2025, management has guided toward $2.35 billion in revenue. Now here is where I want to be completely transparent with you, because this is Smart Stock Sam, and we don't just tell you what you want to hear. Management has also guided for growth to moderate to somewhere between 16 and 19% in 2026. Why the slowdown? Because as they transition from high-margin compounded drugs to lower-margin branded ones, the profitability profile changes. This is the classic growth for stability trade-off, and it is a real consideration. The question every investor needs to ask is whether the long-term strategic positioning is worth the near-term margin compression. Based on everything we are seeing in the institutional data, the big money says yes. Speaking of big money, let's follow the whales, because institutional ownership right now is one of the most telling signals in this entire story. Institutions own approximately 64% of HIMS shares. Vanguard holds nearly 20 million shares. BlackRock is right behind them, and here is the detail that really caught my attention. Munich Reinsurance, a German insurance giant that does not make speculative bets, recently picked up a fresh 338,000 shares. When a reinsurance company starts buying a telehealth stock, they are not gambling. They are making a calculated, long-horizon bet on the future of digital healthcare delivery. And HIMS is backing up that institutional confidence by deploying capital globally, most notably through the acquisition of Eucalyptus, which opens the door to markets in Australia, Japan, and the United Kingdom. This isn't a domestic growth story anymore. It is the beginning of a global platform play. Now let's address the elephant in the room, because if you've been doing your research, you've probably seen the insider selling headlines and felt that little twitch of anxiety. Recently, the CFO and COO of HIMS sold a combined 119,000 shares. On the surface, yes, that looks concerning. Insiders selling is never a feel-good story, but context is everything. These transactions were executed under Rule 10b-5-1 trading plans, pre-arranged, pre-scheduled plans that are set up months in advance, specifically to avoid the appearance of trading on non-public information. This is not executives quietly dumping shares the night before bad news. This is a pre-planned, compliance-approved liquidity event. Does it create a sentiment headwind? Absolutely. Is it the red flag it appears to be at first glance? Based on the structure of the trades? No, but keep an eye on it. If we see unscheduled, discretionary selling in the weeks before earnings, that changes the calculus entirely. Wall Street's professional analysts are also wrestling with this story, and the divide is instructive. Bank of America is playing it cautious, sitting at a neutral rating with a $32 price target. They like the company but want to see the margin story stabilize before getting more aggressive. JPMorgan, on the other hand, initiated coverage with an overweight rating and a $35 target, specifically citing the Novo Nordisk settlement as a, quote, legal turning point. When the world's largest bank says the legal overhang is gone, the market tends to listen. The consensus is cautiously optimistic, which in my experience often means the upside surprises are still ahead. Here is the powder keg sitting underneath all of this. HIMS is currently one of the most heavily shorted stocks in the entire healthcare sector. Nearly 38% of the entire float, approximately 69.77 million shares, is currently held short. That is 69.77 million shares that must eventually be bought back. With a days to cover ratio of up to 3 Any significant positive catalyst could trigger a violent, rapid short squeeze. Short sellers are essentially trapped in a room with one exit, and the door is getting smaller with every bullish data point that hits the tape. Could the short sellers be right? Could a negative earnings surprise see the stock collapse and reward the bears? In theory, yes, but when you combine the fundamental pivot, the institutional backing, and the July regulatory catalyst, the risk-reward is tilting hard in the bulls' favor, and the options market is screaming that message loud and clear. On April 23rd, we saw extraordinary, unusual options activity. Over 216,000 contracts were traded in a single session, and 77.1% of them were calls. The most concentrated bet was on the $30 strike price calls expiring May 1st. This is the smart money in the options pits telegraphing their conviction. They are betting that HIMS not only holds the $30 level, but rallies aggressively through the next earnings cycle. When the put-call ratio looks like this, it is worth paying serious attention. The technical picture supports the bullish thesis as well. The MACD is firmly constructive, clocking in at 0.53, which puts it in strong buy territory. The stock has broken above both its 50-day and its 100-day moving averages, a significant technical milestone that often attracts momentum-driven algorithmic buying. The RSI is sitting between 61.6 and 71.7, which means we are approaching, but not yet, in overbought territory. A brief consolidation or pullback here would actually be healthy and would give the stock room to run. In terms of the technical levels you need to have memorized, your immediate psychological support is $30 flat. Below that, the 50-day simple moving average at $28.91 acts as your next safety net. On the upside, the first meaningful ceiling is at $31.37. Break through that with conviction, and the path clears toward the 200-day moving average, which sits in the $35 to $38 range, right in line with that JPMorgan price target. Now let's put the entire picture together into a 30-day blueprint. The ignition formula for this trade looks like this. You take a 38% short float, you add 77% bullish call volume, and you set the fuse on May 11th. That is the earnings report date. Any positive surprise on that call, whether it's subscriber retention beating expectations, a margin outcome that's better than feared, or early commentary about the July FDA review, could be the spark that sets off the short squeeze. Entry range, based on current price action, $29.50 to $30.50. But the two metrics I will be laser focused on during that May 11th call are subscriber retention and margin compression. These are the make or break numbers. Can HIMS successfully migrate its 2.5 million subscribers from discounted compounded drugs to full-priced branded alternatives without a mass exodus? And when they report the financial impact of that transition, does margin compression come in better than feared, in line with guidance, or worse? Those two data points will tell us whether HIMS is a long-term structural winner in digital health, or whether the $30 breakout was a beautiful bull trap that fades back to the mid-20s. That is my honest verdict. The setup is real, the catalysts are real, and the risks are real. And May 11th is when we find out which side wins. Before I wrap up, I want to be very clear about something important. Nothing in this video is financial advice. I am not a licensed financial advisor. Everything discussed here is for informational and educational purposes only. Investing in individual stocks involves significant risk, including the possible loss of your entire investment. Past price performance is not indicative of future results. Always do your own research and consult with a qualified financial professional before making any investment decisions. The stock market can move against even the most well-reasoned thesis, and HIMS is a high-volatility, high-risk security. Please invest responsibly. All right, Smart Stock Sam family, here is where I want to hear from you. My question for the comments: if HIMS delivers strong subscriber retention numbers on May 11th, but confirms that margins are compressing faster than expected. Are you buying the dip or taking profits and waiting for clarity? Drop your answer below. I read every single comment, and I genuinely want to know how you are thinking about this trade. If this breakdown gave you value, smash that like button. It takes 2 seconds, and it genuinely helps this channel reach more investors who are looking for honest, deep dive analysis. And if you are not subscribed yet, hit that subscribe button right now so you don't miss the May 11th earnings reaction video, where I will give you my live verdict on every number that matters. And if you really want to support the work we do here at Smart Stock Sam, YouTube has a feature called Super Thanks. It's a direct way to support the channel, and it means the world to this community. Thank you for watching, thank you for thinking critically about your investments, and I will see you in the next one.